Welcome back to the home front. I'm your host, Reed Galen. Today, I am joined by Madison Mills. She is a senior markets reporter for Axios. Before that, she was an anchor at Yahoo Finance, covered finance for Bloomberg, and originally hails from the great city of West Palm Beach, Florida, where I spent 5 weeks during the Florida recount in 2000. Madison, you're probably too young to remember that. Welcome.
Thank you so much for having me. I really appreciate it.
So I want to get to how I found you first, and I want to come back to it, which is I saw a video of you describing some changes that the government is making to how 401ks are potentially going to operate. And so then that sort of led me down the rabbit hole. So I want to talk about the delivery of financial news. But before we get to the logistics of it, I want to talk about just what the heck is going on. So I saw a story that you posted this morning that is like, inflation's hot, but don't worry, investors are like, it's okay, we'll be fine. So are we in a space now that Alan Greenspan would have called irrational exuberance?
It depends on who you talk to, right? There are a couple of my sources who say that this is giving 1999 bubble-like energy because valuations are pretty stretched. If you look at a company like Palantir, its PE ratio is putting Cisco's PE ratio in the nice shame. But more broadly, I think there's consensus that some of these high valuations are justified, especially when you think about the AI industrial revolution that's coming. If you listen to someone like Dan Ives from Wedbush, and historically, if you worried too much about valuations, you would miss a lot of these huge big tech names that do end up disrupting, not only the stock market, but the economy and the world, right? And when you talk about the inflation side of things, as long as consumers are willing to put up with that inflation and keep spending, inflation's not a bad thing for corporate earnings, right? Because that's an opportunity for margin expansion. If they can increase their prices and consumers are willing to foot the bill for that, then for investors, that's a sign of potential profit expansion going forward. So that's kind of the bull case of inflation right now. And that's why we're also at the same time so worried about the labor market. Because if we do see bigger cracks in the labor market, if there's, this huge swath of layoffs, a huge rise in unemployment, then obviously that hurts consumers' ability to continue to spend and therefore hurts that profit margin thesis.
Right. And so to that end, what is the sense of when it comes to tariffs and inflation, where do those things intersect? And then the last question is, when they do intersect, is there a predetermined pain point for consumers where they say, I'm just not going to do it anymore? I call it, Madison, to make it really dumb because I'm bad at math, is the Home Depot test. Are people still willing to go to Home Depot on Sunday and get the stuff they need for their house, for their garden, everything else? If something goes up $3, maybe they'll still do it. If it goes up $30, would they still do it? How does that work for most consumers, at least in your experience?
Well, I think you bring up a really great point, which is that I think most of us have a better sense of the economy than we give ourselves credit for. Like, what your friends and family are talking about. Whether or not a bunch of people are laid off and can't find a job. So I think that's a great litmus test with the Home Depot test. What I'd say about tariff-driven inflation specifically, and Barclays had a great note out about this morning, is that it's such a slow drip on its own, especially because of the way the administration is putting out these tariffs. The on again, off again, snip, snap nature of these tariffs is making it a little bit harder to see, this one-time inflation spike. We do know from a variety of sources that tariffs are expected to add about $2,400 a year in additional costs per household. But it's so spread across a variety of different products and services that it's not like overnight we're all going to go to a store and have something be incredibly more expensive and it'll be clear that was tariffs. It's a little bit more nuanced than that, which is also part of why the Federal Reserve is having a tough time sussing out the economy right now, because for so many reasons, the way that the tariffs have been rolled out, but also because companies were able to pull forward a lot of inventory ahead of the implementation of tariffs. It's been really hard to get a clear sense of like the degree to which that policy is driving inflation right now.
Well, so on tariffs, just to stick with that for a second, Trump earlier in the week was crowing about the fact that tariffs were drawing billions and billions of dollars into government coffers. But then you just said something. It's going to cost consumers on average $2,400 more a year. And I believe that Goldman Sachs put out a report that I think the president was very unhappy about too, saying about 2/3 of Americans would feel some sort of pinch from this increase in costs. So if a consumer is paying money, even if it's to Home Depot that ultimately goes to the government, isn't that a tax? Or is that just something that we're just saying, well, that's just how the world works now?
Well, a lot of my sources and economists I speak to would say that tariffs are a tax on consumers. I think it depends, and this points to, the differing political views of folks who I speak with all the time on tariffs. We have seen a huge increase in revenue. And for people who are really worried about the deficit, maybe they're excited about the ability for tariffs to cut down on the deficit potentially. We've seen already that tariffs have brought in nearly $30 billion in revenue a month, and that's expected to grow to nearly $300 billion a year. Obviously, the deficit sitting at around $37 trillion. That's a tiny drop in the bucket. But the hope is that, when the president is taking in 15% of revenue from NVIDIA's chip sales to China, combine that with tariffs, combine that with domestic investment from the likes of Apple, that all of this adds together to help chip away at that deficit. So I think the people who've been really concerned about the debt pile that the US has taken on are happy to see a little bit of progress to that end. But then the other economists who I speak to say that the Federal Reserve had finally started to get us to a good place on inflation. We'd finally started to see some good progress when it came to bringing down the punch of that inflationary pressure that we saw coming out of the COVID-19 pandemic off the back of those stimulus checks. And it's tough to now have this policy in place that could fuel more inflation right when we were finally starting to really get back to and closer to that 2% target for inflation that the Federal Reserve has been so focused on.
Right. And I want to stay on the NVIDIA piece. So NVIDIA basically cut a deal with the Trump administration so that they can sell their products, their chips into China. But to do so, they have to cough up the first 15% of revenue to the federal government, or is it profit?
I believe it's revenue,
Okay.
but that is a good question. I believe it's the revenue but just specifically from those chip sales to China.
Right, but China's not exactly a small market, certainly not when it comes to microprocessors. I mean, do you expect, based on what you've seen from covering the first Trump administration financially and now this one, all of the things we thought we knew about how the government was supposed to react vis-a-vis the economy seem to be out the window. The sort of old neoliberal, let markets rule and all that seems to be vanishing pretty quickly with Trump literally making, and I'm not asking you for a political opinion here, I'm asking you for a financial one, where he's literally making deals, I'm going to put that in air quotes, on a one-on-one basis, which would seem to be, one, unprecedented, but two, at least in my mind, a little bit risky with the world's largest economy.
Well, it's another it depends scenario, because if you're an investor in NVIDIA, this was largely positive news. I was talking to NVIDIA investors who were celebrating earlier this week because this opens up a whole new revenue pie for NVIDIA. And there were some kind of gray market things going on. Like NVIDIA chips were getting into China previously, but this obviously makes it a lot easier. And we're expecting to see NVIDIA have up to $15 billion in additional revenue from this deal. So if you're an NVIDIA shareholder, this is just more earnings growth to come. More broadly to your question, though, about the kind of unprecedented nature of some of these policy moves, I've been speaking with a lot of economists and historians this week who have drawn parallels between the policy of the Trump administration to the leadership and decisions that we've seen come out of emerging markets previously, thinking about places like Turkey, Hong Kong, even Poland. And what they say is that it's really important to look at the very specific policies of the administration and how they impact things like Federal Reserve independence, the sanctity of economic data. Those are the things that start to get worrisome for some folks and that we've seen lead to economic challenges in emerging markets, things like currency depreciation, market challenges, et cetera. And that's where, not to go on a huge tangent here, but that's where the bond market starts to come into play. If we do start to see, a big concern when it comes to the economic data, this independence of the Federal Reserve, what my sources tell me is that the bond market will respond and price in those mistakes and essentially force the administration's hand to kind of course correct.
So, all right. So let's talk about the bond market, because if I told you that I understood it, I'd be lying. So, explain to us how the bond market serves as that last line of defense against insanity. What do the bond salesmen, who probably get looked down on by the equity guys, what do they do to ultimately maintain some level of normalcy or sanity when they feel like things are going sideways?
Yeah, and to the point of how smart that question is, Reed, I just got a text in from a source right before we hopped on saying that it's a three-way fight between the White House, the Fed, and the bond market, and historically the bond market wins. And we see that in this administration in particular. That's what we saw back in April when the president talked about the yippee bond market. So what can happen here? The bond market is traditionally made up of institutional investors. They got a lot of skin in the game, a lot of money in there. If they start to worry about the administration taking on too much debt or, currency depreciation, a whole variety of things, if they start to freak out, they can say, we're not confident in the US's ability to pay off this debt long term. We're going to get out of long term debt. We're going to get out of 30-year treasuries, for example. When they sell, that pushes up yields. And when yields go up, that pushes up rates. So it doesn't matter what the Federal Reserve is doing. If the bond market decides that they want to get out, they could push up yields and therefore things like mortgage rates, credit card rates, et cetera. And that also pushes up the deficit because our deficit has the same interest rates that people with credit cards have. So that's why the administration and Scott Bessent in particular, the Treasury Secretary, has paid a lot of attention to the bond market and why they want yields to be low, because it impacts their own ability to pay back their debts as well. So that's why we think about the bond market as kind of like the smart money in the room and the ones who do ultimately have a lot of potential power over the path forward for policy.
All right, so let's bring a few of those things together. So you've got the bond guys and gals who can push yields up if they're unhappy. You've got the Federal Reserve, which is sort of like a ship's captain in a storm, trying to figure out how to trim a sail, which way to go, into the wind, with the waves. And then obviously you got the White House, which with not what I would call a boring occupant, not what I would call a predictable occupant. That all seems to be a little bit concerning to those of us who have a lot in retirement. Also, you mentioned emerging markets, not to mention a competitor of yours, but the Wall Street Journal had a story out the other day recalling what happened when Argentina, which is an emerging market, when the Kirchners started screwing with the independence of their financial data. And it really messed with everybody in the country, from people who were trying to buy a home to people who'd been divorced and didn't know how much they owed their ex. So how do you account for all of that? Again, Argentina is a big country, but it is an emerging market. But as I said, now, if you now have a situation where you have a president who's willing to do whatever it is based on how he feels, and now we saw that the Bureau of Labor Statistics, he fires that person. It looks like he might nominate someone who doesn't really, like BLS to begin with, but so much is predicated on what all of that says. How is any normal American supposed to determine how best to invest their money, save their money, protect their money, when there are forces at play that are so much bigger than any one of us?
It's really difficult, right? If it's difficult for the Federal Reserve to figure out the path of the economy right now, it's obviously going to be difficult for consumers who are busy working full time. And, most people have like a target date fund for their 401k, and that's how they're invested. And they kind of leave it at that. So it's really hard for folks right now. What I would say is that obviously I can't give financial advice, but the people who I speak with always point to, the importance of speaking with a financial advisor if you're able to, but also thinking about your risk profile and your time horizon. One thing that gives me a lot of peace is thinking about the fact that the stock market has recovered 100% of the time. And obviously, I'm lucky to have a little bit longer of a time horizon. But even if we do see volatility over time, stocks do go up. And there's a reason that, we have more K millionaires right now than ever, even if the state of the world and the vibes feel negative right now, we are seeing asset prices going up. So if you do own stocks, the data show us that you are more likely than not feeling this wealth effect right now where your asset prices have grown so much that you have done pretty well from like a broad portfolio perspective, even if it doesn't feel that way. And then more broadly, I would say I spoke with a former deputy director at the IMF this week, and he said that he has a lot of optimism about the path forward for some of the things that you mentioned you're concerned about, like the economic data and the sanctity of that data because of the strength of the private sector in the US. Like if we get to a point where the economic data from the BLS is questionable, investors aren't going to allow that. Like some private sector company, in his view, will come forward with their own data, be very clear about how they're gathering it, and the market will move on. And we've seen this market be just incredibly resilient. Think about the pandemic, the supply chain crisis, inflation, and we're in a bull market, you know? So I hear people talk about the resilience of corporate America a lot these days. And that is hopefully something that can give people a little bit of peace.
Well, so let me ask you a vibe question then.
Mhm.
Why, if the arrows appear to be pointing in the right directions, are so many people so bearish on outlooks individually? If all the smartest guys in the room are supposed to feel good, then why do so many individual Americans, investors, and just employees, feel like the world is a little bit upside down? Is that just the nature of life? I mean, I don't want to ask you sort of like a philosophical question, but there seems to be a disconnect between how markets feel about the world and how Americans feel about the world.
Yeah, and this is where markets are not the economy, right? And the analysts on Wall Street who I talk to, they're bullish on the next 3 to 6 months. They're not talking to me about their retirement funds. They don't know what's going to happen in 20 years. We barely know what's going to happen 6 months from now. So that's already going to lead to a disconnect. And then I'd also say doubling down on this sort of idea that we're really having this K-shaped recovery right now, and that's what I hear a lot from people who I speak with. And that's the idea that the rich get richer and the poor get poorer. And like we're really seeing that divide playing out significantly right now. Even with regards to the labor market, like people who have a job are doing okay. We're seeing wages continue to go up slightly. People who don't have a job, it's nearly impossible for them to find one. We're seeing such a low hire, low fire labor market right now. And then at the same time, you also still have inflation looming in the background. You have tariff driven inflation potentially coming down the pike. And people who don't own stocks or a home, who aren't benefiting from that wealth effect of asset prices going up, they don't have that kind of counterweight. They're just feeling the negativity of the labor market, inflation. If they're in that lower part of the K-shaped economy, that's a really tough position to be in. Meantime, you have, I think Moody's had a stat recently on the top 10% of earners make up nearly half of spending in the US.
Right.
If you're doing well, you're doing really well right now. But if you're not doing well, it's a really tough environment for folks from a lot of ends of things.
Well, and I posted a piece on my Substack, the Homefront, subscribe today, about this. It was more political, but there were a lot of economics involved here,
Yeah.
and 57% of Americans are living paycheck to paycheck. The
Yeah.
definition of that being that you can't basically afford $1,000 financial emergency. And that would seem to me to be both economically difficult, but also sociologically and politically volatile, which is to your point about the K-shaped recovery, if the people doing well, if the people who already own all the stuff are doing better and the people who already own nothing are doing worse, there's only so long that the people who are doing worse are going to be like, oh yeah, this is great. Right. I mean, and there are, we have with 330 million Americans, you can't just tell 150 million Americans, 175 million Americans, sorry, too bad for you.
Yeah, I mean, this came up in a source meeting I had this week. As a source who was telling me that K-shaped recovery is fueling, in his view, some of the partisanship that we are seeing as well. That like as the class divide gets bigger, then we're also seeing the political divide get bigger as well. And in his view, that's in part why this source was talking to me about people who are both pro-Trump and pro-Bernie Sanders. Like they're just looking for something new because they've been struggling so much, and they are kind of looking for anything that rebels against like previous political systems that we've had in place. And I can also say that I I'm in New York City and I covered a little bit Wall Street's response to the success of Zohran Mamdani. And I think that also points to this class divide. Like a lot of the wealthier sources I have were really surprised by his success, but a lot of just by nature of being younger and living in New York City, I was not surprised by that success. And also the polling indicated that he was successful as well. So I think that also just points to the fact that Americans are wanting something different. And you would know better than me how that's played out on a political side of things. I obviously focus on the Wall Street end.
Sure.
But
Well, no,
yeah.
and I think we've seen it, which is a guy like Donald Trump doesn't get elected when people feel good about things. He tends to get elected when people feel bad about things. And to your point about the Trump sort of Sanders horseshoe, I'll call it, if you go back to 2016, and this is an observation, if you go back to 2016 and you listen to a Donald Trump speech in the Republican primary and a Bernie Sanders speech in the Democratic primary, Sanders leaves out sort of the ugliness of Trump's rhetoric, but they were very simple, very straightforward, very progressive economically, and very populist economically, right? They were almost in line with one another ideologically and financially, which is the big guys are getting healthy, you're the little guy, you're getting screwed. And people are like, you're right, we are. And I think that's what I think you see in the response to somebody politically like Trump, which is, it doesn't matter what people say. I'm not getting ahead. I'll take the guy who channels my anger and says he'll change and burn it down, even if that's bad for me, because I'm sick of what's been going on. All right. So now I want to switch from the substance that you create to how you deliver it, because I think this is a very key thing for my listeners. We tend to be, Gen X, maybe baby boomers. Tell us, how is it that you are trying to communicate what you're covering in the economy to your generation and to younger Americans? Because I feel like, it's very easy to put your head in the sand. But as you said, you live in New York, you're a younger person, you feel it, you understand the Mamdanis of the world. So tell us a little bit about how you are not only, posting in Axios every day, writing stories about the economy, but also, again, as I said at the top, how I found you, which is you were doing a video about a very specific change to an economic thing, this being 401ks.
Yeah, I would say that it's really important to me and sort of just a personal mission to democratize access to financial news and information. I think, especially in the world of finance, it can feel like really gatekeepy and like difficult to just inaccessible. And I've always felt like at the core of the journalism I want to do is obviously like the highest approximation of the truth, which we talk about at Axios all the time. But I also want to make sure I'm reaching people in a way that's accessible and engaging for them and meeting them where they are. And that's not always in traditional forms of media. I just came off of a stint where I was anchoring very traditional television programs, which was really great career experience. But I find that I often do TikToks that have much wider reach, and I get a lot more audience engagement of people asking questions, telling me that they just started investing for the first time, than I ever did when I was, getting up at 3 a.m. to anchor a television news program. So
Right.
that kind
6
of
minutes at a time reading off a teleprompter, right?
exactly. And I'm sure you feel the same way in terms of you're always iterating your kind of content deliverables and formats and things like that. But I just find it like really rewarding to reach people where they're at. And so that's why now I write a daily newsletter for Axios, which I think is another incredibly smart way to reach people and get in their inboxes. It feels really personal, but the social media side is also really important to me. So I've just kept doing that too.
So let me ask you, so as you've been recording the TikToks, and I think maybe I saw you on Instagram, what are some of the most interesting questions people have asked you? Or
That's a
surprising?
great,
Interesting or surprising, I'll take. Or ridiculous or
yeah.
crazy, or things that go, I can't believe that, just give us something that sort of really points to that I know it's a parasocial relationship, but that ability to answer someone's very specific question, or surprising, or you're like, wow, that's a really good idea.
Well, they give me good story ideas all the time. I mean, even when I think the video you saw was about changes coming to our 401ks, and it's really interesting seeing things like gender divides in my comments, for example. And this is backed up by data, right? We know that women tend to be less pro risk in their investments, and men tend to be a little bit more pro risk. And I totally saw that playing out in my comment sections. Like, men were so excited about getting crypto in their
Oh
401ks,
my
getting
God.
access to private credit. And women were a little bit more asking me, like, hey, can you figure out for me how I can avoid this? Because I don't want my target date fund getting messed up. And that's helpful information for me too, because that gives me questions that I can go ask experts of, like, hey, what are the options for people? And should people be worried about this, or should they be really excited? Like, there is a lot of excitement out there. How justified is that? Is there anything I can tell them that they should be looking out for? And so I think it just like helps me be a better reporter because I get access to all these different viewpoints on things.
Well, if you were going to tell me that and tell me something I could be less surprised about, I'm not sure. Yes. I mean, I have a working theory that so far, I'm not going to call it Galen's law quite yet, but a working theory that men basically top out on the maturity scale as soon as we get a driver's license. And the rest is just aging from there. So yeah. And you know, it's interesting when you said the gender divide on crypto, that was the first thing that came to my mind, right? Which is I have some
Yeah.
friends who got in it. They love it. And it's like very exciting, right? It's this thing. And I as I've said to other people, you know, on the show, like I remember meeting the first Bitcoin people better than a decade ago going, I can't figure out what any of this is. I can't figure out why these people are true believers in something called the blockchain. And if I had bought Bitcoin at 11 cents then, you know, maybe you and I probably wouldn't be having this conversation. But,
Yeah.
you know, it is one of those things where it has been made cool. And as you know, so much about the economy is how you feel. And that's how we started, right? Which is there's a lot of exuberance. People feel good about the economy, people feel good, or I should say, investors feel good about the economy, companies feel good about the economy, the markets are going up. But as we've seen before, it only takes one nervous elephant, right, to start the stampede.
And the economy has changed so much. I think I already said the line of the market's not the economy is not the market, but we're seeing that young people are living at home for so much longer, and that's allowing them to have a lot more spending power. Young people aren't saving for a home as much because it feels impossible to get to $100,000 plus closing costs and all of those other things. So you
So
might as
that
well
then
just
you can pay 7%, right?
exactly,
Yeah.
exactly. And then if you're not saving for that, well then you can buy the Labubu toys because you have more disposable income at your disposal. So
Please don't buy the Labubu toys. That will be my financial advice for the day.
you're not a fan, Reed.
Please don't do that.
You're not a
Please
fan.
don't.
Yeah.
No.
But the appreciation of the asset.
Well,
No,
look,
I'm
all
kidding.
right, look, I've got a collection behind me of pet rocks and beanie babies. So anybody that wants some, let me know.
You will ship it out to people. Yes.
Exactly right.
Yes.
Postage paid. All right.
Exactly.
Well, before I let you go, give us one more thing that you think is really interesting on your beat, and then where folks can find you on Axios, and then where they can find your terrific videos and explainers on how all this works.
Yeah, I mean, I would say I can break down the K changes a little bit. Obviously, the president's executive order aimed at making it easier for plan managers of retirement plans to increase allocation to riskier assets, ranging from private credit to private equity to crypto. My sources tell me this is like a long time horizon of 5-10 years because committees don't like to change your target date fund allocation too frequently because that can freak people out. But other sources tell me that this could be kind of a really interesting change where we start to see plans offering target date funds with and without access to these like riskier investment products. You could see, a 2050 target date fund with private credit and without it. Whether or not that choice starts to like freak people out is something else that plan managers will have to monitor. I think that that's a fascinating story because so many people, the way that they are experiencing their own investments is just through their 401k. So I think that that's something that I'm going to be obsessed with for the near term. Other than that, you can subscribe to the daily markets newsletter for Axios by going to the Axios website, typing in Axios Markets, and I'm at Madison Mills there. And then I'm on TikTok and Instagram at Maddie Mills as well.
Awesome. Well, and one other story I read, and I'll have you back to discuss this, is that people are starting to pull more money out of their 401ks and IRAs for emergencies or things they need, even with the tax implications and the penalties. So there's a lot more to talk about on that regard, because it looks like we're sometimes robbing Peter to pay Paul. All right, as always, gang, you can find me on Twitter and TikTok and says.us at Reed Galen, on Threads and Instagram at Reed_Galen USA. And of course, subscribe to the Home Front today. Madison Mills, thanks for joining me.
Thanks so much.
And everybody else, we'll see you next time.